Hello everyone, welcome to Boss Economic World. I'm Boss. Today is December 4th, 2025. If you've been watching the markets this week, you might have felt a tremor. It wasn't an earthquake in Tokyo, but it might as well have been. We are witnessing a historical pivot that feels like watching a lifelong vegetarian suddenly order a rare steak. The news hitting the wires today is big. It's the kind of news that makes bond traders sweat through their expensive suits. Prime Minister Sanae Takaichi, the self-proclaimed disciple of Shinzo Abe, the Iron Lady of monetary easing, is reportedly not going to stop the Bank of Japan from pulling the trigger this month. That's right. The government is stepping aside. The Bank of Japan, led by Governor Kazuo, is poised to raise the benchmark interest rate to 0.75% at the policy meeting on December 19. Now, you might be thinking, boss, 0.75%? In the US, we pay more than that on a credit card just for looking at it. Why is this news? Because, my friends, in Japan, 0.75% isn't just a rate hike, it's a regime change. It is the final nail in the coffin of the era of free money. And the fact that Takaichi, who built her career screaming for loose money, is allowing this to happen, tells us that the Japanese economy is facing a crisis that printing money can no longer fix. Today, let's analyze the truth behind this sudden green light from the government, restore the full picture of the political and economic game being played in Tokyo, and figure out what this means for your wallet, whether you're trading Forex in London or buying imported electronics in Osaka. Let's pop the hood on the politics first. Everyone knows Sanae Takaichi. When she ascended to the prime ministership, the market panic was palpable. Why? Because she was the ultimate advocate of Abenomics. Her philosophy was simple: print money, keep rates at zero, crush the yen to help exporters, and stimulate growth. She was supposed to be the nightmare scenario for anyone betting on a rate hike. So, when Bloomberg reported today that key members of Prime Minister Sanae Takaichi's government wouldn't try to stop the Bank of Japan, it shocked the algorithm traders. But should we be shocked? Let's look at the data. Look at the yen. Immediately before this news dropped, we were hovering around 155.04 against the dollar. After the news? It strengthened to 154.77. A modest bump, but a clear signal. Here is the uncomfortable truth that Takaichi has had to swallow: a weak yen is no longer a patriot, it's a traitor. Back in 2013, when the yen was at 80, weakening it to 100 or 110 was great for Toyota and Sony. It made Japanese cars cheap abroad and profits soared. But at 155? In 2025? It's a disaster for the average voter. Japan imports almost all its energy and a huge chunk of its food. When the yen is trash, the price of gasoline, electricity, and bread goes through the roof. Takaichi might love loose monetary policy, but do you know what she loves more? Keeping her job. Her approval ratings have likely been taking a hit because real wages, what people can actually buy with their salary, have been struggling to catch up with inflation. If she blocks the BOJ and forces rates to stay low, the yen could crash to 160 or 165. That would trigger an inflationary spiral that would vaporize her government. So, the Iron Lady has made a calculation: it is better to tolerate a 0.75% interest rate than to face an angry mob of voters who can't afford heating oil this winter. Now, let's talk about the man of the hour, Governor Kazuo. This man is an academic, but he's playing the political game like a grandmaster. On Monday, speaking in Nagoya, Ueda dropped a line that sounded boring to normal people but sounded like a siren to Wall Street. He said the bank would consider whether to raise rates at the upcoming meeting. In central bank speak, the word consider is heavy. It doesn't mean we'll think about it while drinking tea. It means, get ready, it's happening. Ueda used this exact same formulation back in January of this year, right before he hiked rates then. He is telegraphing his punch. He doesn't want to surprise the market, he wants to guide it. And look at the response from the government. The day after Ueda spoke, Finance Minister Satsuki Katayama held a press conference. Did she yell at Ueda? Did she say, "How dare you threaten our recovery"? No. She said she expected the central bank to appropriately conduct policy toward achieving its 2% inflation goal and that specific methods were up to the BOJ. Translation: you do it, Kazuo. If the stock market crashes, we'll blame you. If inflation goes down, we'll take the credit. This is the joint accord of 2013 in action. Officially, the government and BOJ coordinate policy. But practically, the government is washing its hands of the decision to let the BOJ do the dirty work. Let's look at the numbers, because feelings lie, but swap spreads don't. Prior to this week, the market was skeptical. Takaichi is in charge, right? She won't let them hike. The probability of a December hike was sitting around 58% at the end of last week. It was a coin toss. But following the Bloomberg news on Thursday, citing those three anonymous government sources, the overnight index swap shot up. We are now looking at an 87% likelihood of a move this month. The market has moved from maybe to definitely. Why? Because the friction is gone. The only thing holding the BOJ back was the fear of political retaliation. With that threat removed, the economic fundamentals scream for a hike. Let's look at the wider economic context of late 2025. Global inflation hasn't fully disappeared. The US Federal Reserve has likely paused its cutting cycle or is cutting slower than expected because the American economy remains stubbornly resilient. This means the yield gap, the difference between earning interest in dollars versus yen, is still massive. If you can get 4.5% in US Treasuries and 0.5% in Japanese bonds, you sell yen and buy dollars. That pushes the yen down. The only way Japan can stop its currency from becoming confetti is to narrow that gap. Moving to 0.75% is a baby step, but it shows intent. Now, for my friends in the financial sector, let's talk about why this matters for your portfolio. For 2 decades, shorting Japanese government bonds, betting that rates would rise, was called the widowmaker trade. Because rates never rose, and anyone who bet they would lost their shirt. But the widowmaker is dead. The new reality is the carry trade unwind. Billions of dollars of global liquidity are funded by cheap Japanese yen. Hedge funds borrow yen at 0.5%, convert it to dollars, and buy Nvidia stocks or Brazilian bonds. It's free money. But what happens when the cost of borrowing that yen goes up? What happens when the yen strengthens? If you borrowed yen at 155 and it goes to 145, you have to pay back the loan with more expensive currency. Your profit margin vanishes. You have to sell your Nvidia stock. You have to sell your Brazilian bonds. This is why a 0.25% hike in Tokyo can cause a sell-off in New York. The fact that Takaichi is allowing this hike suggests that the Japanese government is terrified of the reverse problem, capital flight. They need to make Japanese assets attractive enough so domestic money doesn't flee to the US. Here is the Boss Economic World deeper analysis. Why did the Reuters report cite 3 government sources saying they would tolerate the move? Why leak it now, 2 weeks before the meeting? This is a managed expectations game. If the BOJ hiked on December 19 without this leak, the Nikkei stock average might have crashed 2,000 points in shock. Takaichi's donor base would be furious. By leaking the tolerance now, on December 4, they are letting the market price it in gradually. The OIS moving to 87% is the safety valve releasing pressure. By the time the actual announcement comes on the 19th, the market will yawn and say, "We knew that." It's a classic bureaucratic maneuver. It allows Takaichi to maintain her pro-growth image while secretly allowing the anti-inflation medicine to be administered. Furthermore, there is a nuance in the reporting. Some senior officials oppose that timing. Of course they do. There is always a faction in the LDP that wants zero interest rates forever because zombie companies, inefficient firms that only survive on cheap debt, will go bankrupt if rates hit 1%. But Takaichi sees the writing on the wall. The era of protecting zombie companies is ending because the cost of protecting them is now higher than the cost of letting them fail. So, what happens next? If the BOJ hits 0.75% in December, the ceiling is broken. The psychological barrier is gone. The market will immediately start pricing in 1% for mid-2026. This changes the calculus for Japanese corporations. For 30 years, Japanese CEOs sat on piles of cash and didn't invest because deflation made cash king. Now, if inflation is 2.5% and cash yields 0.75%, you are losing money in real terms. You have to invest. You have to raise wages. Ironically, raising rates might be the very thing that finally normalizes the Japanese economy. It forces capital to move. However, there is a risk. The Japanese government debt is monumental, over 260% of GDP. As rates rise, the interest payments on that debt skyrocket. The Ministry of Finance is terrified. This is the needle Takaichi and Ueda are threading. Too low, yen collapses, inflation kills the voters. Too high, debt service bankrupts the government and crashes the stock market. 0.75%, the Goldilocks zone of pain. It hurts, but it's survivable. To wrap this up, let's look at the big picture. For a generation, Japan was the economic anomaly of the world. The land of falling prices and zero rates. That island is sinking. We are rejoining the global mainland of positive interest rates and sticky inflation. Prime Minister Takaichi, the supposed guardian of loose money, has blinked. She has surrendered to the reality of the market. The yen at 155 was the gun to her head. On December 19, barring a catastrophic global event, the BOJ will hike. The era of the yen carry trade dominating global liquidity is entering its twilight. For you, the investor, or the observer. 1. Watch the yen. If it breaks 150 significantly, look for volatility in US tech stocks as the carry trade unwinds. 2. Watch the Nikkei. It might dip, but banking stocks in Japan will likely outperform. 3. Watch the politics. Takaichi is walking a tightrope. If this hike causes a recession, she will be out, and the political chaos in Japan will offer new trading opportunities. The government says they wouldn't try to stop the BOJ. In the world of power politics, that is the same as signing the order yourself. The train is leaving the station, folks. 0.75% is the destination. Make sure you're not standing on the tracks. This has been Boss, analyzing the currents of the boss economic world. If you want to survive the tsunami of 2026, keep your eyes open, your leverage low, and your mind sharp. See you in the next episode.